Good day, ladies and gentlemen. Welcome to Everyday Finance with Jay. My name is Jay. It's the time of the year again where either you get a big fat paycheck from the government or unfortunately you have to pay some money to them. What I'm talking about is tax return. You have until April 15th for the 2019 tax return, and today we're going to cover 3 things you can do right now, a month and a half before the deadline, that can save you hundreds of dollars, if not thousands of dollars on your tax return. Please comment down below if any of these tips helped you and any questions you might have for any financial topics that interest you. And the reason I'm making this channel and these videos is to help people, so please subscribe and like this video so that the YouTube algorithm does its thing, so in which these videos can reach more people. Number 1 is to contribute to a traditional IRA. You have until April 15th to put away $6,000 into a traditional IRA for the 2019 tax return. And if you're 50 years or older, you can put away an additional $1,000. You might say this, traditional IRA can help me save for retirement, but what does it have to do with tax return? The amount of money that you put into a traditional IRA can lower the amount of taxable income that the government calculates in order to see how much money you have to pay in taxes. Unless you make above a certain amount of money, contributing to a traditional IRA will save you money on taxes and benefit you for retirement. And if you make too much, you can contribute to a Roth IRA. To find out the limit, you can look that up online. Let's go over an example with this. Let's say you make $45,000 last year, and you can calculate for yourself, depends on how much more you made above that or below that. With $45,000, normally the government would calculate the federal tax brackets and tax you on all $45,000. The beauty of a traditional IRA is that, let's say you're able to put $4,000 into a traditional IRA. That means the taxable income that the government is going to calculate how much taxes you owe will be reduced by $4,000. So it will be reduced from $45,000 to $41,000. And with that reduction and that tax bracket, you'll be saving $880 in taxes. That's a lot of money. Let that sink in for a moment. Now you wonder, the limit is above $4,000. What if you are able to contribute more than $4,000? Let's say you're able to put away $6,000. And if you, the example we're going over, $45,000, $6,000 in a traditional IRA can mean up to $1,320 of tax savings. That's like a vacation of plane ticket, gas money. You can do so much with that money instead of giving that to the government and saving for retirement. And if you have not done this before, there are several investment companies you can utilize. Some of the ones such as Fidelity and Vanguard are the big ones. And if you don't feel like investing on your own, there are these robo-investors where they will do the investment for you, such as Betterment or Wealthfront. I have a link down in the description box to more details about what we just covered. Number 2 is to fund a health savings account. Basically, it's a savings account for medical expenses that is not already paid by your insurance company. And the reason why a health savings account is better than a regular savings account when you choose to pay for medical expenses, several factors to consider is, number 1 is the money that you put into a health savings account is before any taxes have been taken out, is pre-tax money. And that being said, it can lower your taxable income. Just like the example we went over in the previous, in number 1, it can lower the amount that the government will calculate to see how much taxes you owe. And because it is like an investment account, the money will grow tax-free. So for example, in a regular savings account, the money that you earn, the interest, you have to report that interest every year to the government and you have to pay taxes on it. But in a health savings account, you don't have to do that. And the third benefit is that for qualified medical expenses, the money that you pull out of the health savings account, you don't have to pay taxes on it. That's win, win, and win. So for a single person, the limit every year is $3,000 and $3,500, and for a couple, it's $7,000. And if you're 55 years or older, you can contribute an additional $1,000. And that being said, that can be a tax saving of over $700. And in combination with step number 1, right now we can still save up to $2,000 in tax savings with just the first 2 tips that we just covered. Number 3 is to collect tax credits. A tax credit can lower the amount of money you have to pay to the government or increase the amount that you get back. It's a dollar for dollar equivalence. What I mean is, for example, if you are getting a check from the government for $500 and you're able to collect $1,000 of tax credit, that will increase the amount of money you get back from $500 to $1,500. And the other side is also true. If you owe $2,000 to the government, you have $1,000 in tax credit, that will drop the amount of money you owe by $1,000. A tax reduction is basically lower the amount of taxable income, the total income that you made, in which the government will use to calculate how much taxes you owe. Between tax credit and tax reduction, the credit is a lot better for us. And some of the tax credits that your tax person will hopefully talk to you and ask you about whether you have them are some of the first is if you have a child under the age of 17 living with you, you're able to claim $2,000 of tax credit. And then also, if you pay for daycare or child service, and depends on how much you pay and how much your income is, you're able to claim some of those expenses as tax credit. And the third we're covering today is earned income tax credit is for more of modest to low income families or person. You're able to look into that. The 3 things we covered today. Number 1 is to contribute to a traditional IRA. Number 2 is to contribute to a health savings plan. And number 3 is to look into tax credits. And comment down below if any of these tips helped you. And for 2020 tax return, so the one you will fill next year, one thing you can do now is to contribute more into your 401k, 403b, whatever retirement plan that your work employment has, because that will lower the taxable amount of income the government will use to calculate how much taxes you owe. And that will save you the most over 1 year until next year than some of these we have covered today. And thank you so much for watching. Comment down below with any questions you might have. See you guys.
You as you drive, do you know I'm looking, and I can't help but smile. Do you know how much I love you?